Thousands wake up every year to find their trades don't exist anymore. Not liquidated by the market. Liquidated by someone who changed the margin requirement while they slept. Right now, Monday morning, December 28th, 8:30 a.m., silver traders worldwide are watching their positions get forced closed. Shanghai opened at 8,620 yuan, roughly $88 per ounce. Hours later, 7,680 yuan, $79, maybe $80. That's an $8 morning collapse. New York COMEX silver opened $80.50, crashed to $75.68, 5 to 6% gone in hours. This isn't supply. This isn't demand. This isn't economics. This is Chicago Mercantile Exchange raising margin requirements from $22,000 to $25,000 per contract, 13 to 14%. Immediate, not tomorrow. Today, 10 contracts, fine $30,000 cash in hours, or your broker closes everything and you eat the loss. This is where it turns dangerous. Margin is the security deposit for futures. One silver contract controls 5,000 ounces. At $80 per ounce, that's $400,000 of silver. You only needed $22,000 to control it. That's the leverage. That's why futures exist. But here's what almost no one realizes. Exchanges change margin requirements whenever they want. No permission. No advance warning. When margins spike, traders face instant cash shortages. Can't meet the requirement? Liquidated. Forced selling drives prices down. Lower prices trigger stop losses. More liquidations. More selling. Manageable corrections become crashes. The cascade doesn't stop cleanly. Nothing here is financial advice. This is market event analysis for education only. Futures trading carries substantial risk. Never trade money you can't lose. Consult a licensed advisor before any investment decision, but understand who wins when forced liquidations crater prices. Short sellers. Traders who sold silver contracts they don't own, betting on decline. They profit when prices fall, but short selling has unlimited risk. If prices keep climbing, shorts face catastrophic losses. According to Hindu Business Line, there are approximately 41,000 call option contracts at a $75 strike. Call options give holders the right to buy silver at $75 regardless of market price. If silver stays above $75 and these holders demand physical delivery, actual metal, there's a serious problem. Each contract represents 5,000 ounces. Multiply by 41,000 and you're looking at 205 million ounces that might need delivery. The issue, there may not be enough readily available silver to fulfill delivery demands. This creates a delivery squeeze where shorts are forced to buy back positions at any price to cover obligations. The nightmare scenario that bankrupts institutions. Some analysts believe the timing isn't coincidence. Raising margins, just as silver approaches critical option strikes, may be cooling the market to prevent a short squeeze. Is this proven? No. Exchanges claim they're managing risk and protecting stability. But the timing is extraordinarily convenient for shorts facing potential disaster. This is no longer theoretical. Let me show you the pattern because it repeats. Prices surge. Retail enthusiasm builds. Short sellers accumulate massive losing positions. The exchange raises margins citing volatility or risk concerns. Forced liquidations crush prices. Shorts escape with smaller losses than they'd have faced otherwise. After the dust settles, prices often resume upward. But retail traders are already gone. Silver in 1980. Oil in 2008. Bitcoin futures in 2017. The playbook works because retail traders max out leverage, maintain minimum margin cushions, and have no choice but to liquidate when requirements jump. Institutional players with deep capital weather the storm or profit from the chaos. The spread between Shanghai and New York tells you about supply dislocation. Yesterday, that gap hit $8 per ounce, severe separation indicating physical silver was in far higher demand in Asia. This morning, the spread compressed to roughly $5. Forced selling on COMEX dragged New York prices down closer to Shanghai levels, narrowing the arbitrage gap. What does this mean going forward? Either supply shortage concerns are being relieved by selling pressure, or COMEX prices are being artificially suppressed below true equilibrium. Once forced liquidations end, prices might snap back violently to reflect actual physical conditions. That's the question traders are trying to answer right now. According to Hindu Business Line, COMEX didn't just raise margins, they allegedly cut position limits, meaning traders can't hold as many contracts as before. I haven't independently verified the position limit cuts through official COMEX documentation yet, but if accurate, this creates a double squeeze. Even if you have capital to meet higher margins, you might still be forced to reduce positions if you're over new limits. The warning traders found in account notifications. If you don't have required funds by Monday, positions will be liquidated. That's today, right now. Brokers worldwide are auto-closing positions for traders who couldn't raise additional capital. Think about this practically. You entered silver weeks ago at $65. You watched it climb to $80. You're sitting on substantial profit. Overnight, the exchange changes rules. You need thousands more dollars within hours. Maybe you don't have liquid cash. Maybe your money is in other investments. Maybe you're in a different time zone and don't see the notification until too late. Your broker doesn't care. Position liquidated automatically. You might still profit, but you've been forced out of a winning trade before you chose to exit. This window is already closing. 5 critical lessons to protect yourself regardless of what you trade. Never operate at minimum margin. Maintain at least 150 to 200% above minimum levels. Yes, this reduces leverage and slows gains. But you survive unexpected rule changes without forced liquidation. Position size for worst-case scenarios. If margins doubled overnight, could you meet them? If no, your position is too large. Understand you face 2 risks in futures: market risk, normal price action, and regulatory risk. The risk that exchanges change rules in ways that hurt your position. Most traders only think about market risk and get blindsided. Watch options calendars closely. Significant open interest at specific strikes, a special out-of-the-money calls requiring massive physical delivery if exercised. That's a red flag for exchange intervention. Exchanges monitor this constantly. Major players watch it. You should too. Diversify not just across assets, but across exchanges and jurisdictions. Don't concentrate all commodity exposure in COMEX contracts. Spread between different exchanges, contract months, even different exposure methods like ETFs or physical holdings alongside futures. One exchange's policy change can't destroy your entire position. What makes this more interesting? Option traders holding those 41,000 calls at $75 typically don't demand physical delivery. Options are usually cash settled. You collect profit and move on. Actually taking delivery of 5,000 ounces per contract involves logistics, storage, complexity most traders avoid. But what if some holders are major industrial users? Solar panel manufacturers, electronics producers, industries that actually need physical silver for production. These companies have infrastructure to take delivery. Storage facilities, immediate use for the metal. If even a fraction of those 41,000 contracts are held by industrial players who decide to stand for delivery, it creates genuine supply problems for shorts who'd have to source and deliver physical metal. This is the scenario that has shorts worried. It's not just price movement. It's potential for physical delivery squeeze forcing shorts to buy silver at any price to meet obligations. This reveals power dynamics in modern markets, where top markets are driven by supply and demand, that prices reflect collective wisdom of all participants, that it's a level playing field where best analysis wins. But events like this pull back the curtain. Exchanges have enormous power to influence outcomes. They change rules, forcing certain participants out while protecting others. They do this with minimal notice and zero accountability to individual traders. Does this mean markets are rigged? Too simplistic. Exchanges have legitimate reasons to adjust margins. When volatility increases, default risk increases. Higher margins protect the clearinghouse and the entire financial system from cascading failures. If a major participant defaulted on massive silver positions, it could create systemic problems affecting everyone. But timing and targeting of margin increases can certainly be questioned. Why raise margins during a bull move but not during a crash? Why target the commodity with massive short positions at risk? Fair questions deserving scrutiny. For you as an individual trader, whether this is manipulation or risk management doesn't change your tactical situation. Your job is to survive and profit within rules as they exist, not as you wish they were. That means trading defensively, assuming exchanges will act in ways benefiting large institutions over small traders, building strategies with enough margin of safety to withstand sudden rule changes. Once this starts, it doesn't stop cleanly. What typically happens after forced liquidation events? Short-term, prices stay depressed as selling pressure works through. Liquidated traders are gun-shy about re-entering. Psychological damage takes time to heal. Medium to long-term, if underlying fundamentals driving the initial rise are intact, prices often recover and continue higher. Forced liquidation doesn't change supply-demand fundamentals. If there's genuine physical silver shortage, if industrial demand is strong, if investment demand continues, those factors don't vanish because an exchange raised margins. What changes is participant 1009. Weaker hands shaken out. Stronger, better capitalized players accumulate at lower prices. Only interpretation. Today's action is a violent but temporary shakeout that ultimately resolves with prices moving higher once forced selling exhausts itself. Another interpretation. This is the beginning of larger correction where the bull move ran too far too fast and needs significant consolidation or retracement. Which is correct? Nobody knows for certain. That's why risk management is more important than prediction. The compression of Shanghai New York spread from $8 to $5 provides clues. If that spread continues narrowing over coming days, it suggests market is finding new equilibrium at lower prices. If the spread widens again after initial shock, it might indicate physical demand remains strong and COMEX prices are temporarily disconnected from physical market realities. International reports suggest CME, COMEX's parent company, is attempting to protect participants who went short on silver. Exact quote from trader sources: "The exchange was trying to protect those who had gone short." I cannot independently verify motivations behind COMEX's decision. Exchanges don't announce they're protecting one side against another, but market participants who've been through these situations recognize the pattern. When a commodity is in strong bull market, short sellers accumulate losses. As losses mount, there's increasing risk shorts default on obligations. If major shorts defaulted, it creates chaos and potential losses for the clearinghouse. So from systemic risk perspective, the exchange has incentive to prevent that scenario. Raising margins accomplishes it by forcing longs to sell, bringing prices down, reducing losses faced by shorts. Whether this is actual motivation or not, practical effect is the same. Longs forced out. Prices fall. Shorts benefit. Your job as trader is to be aware this dynamic exists and trade accordingly. When someone sells a call option, they're taking on obligation. If buyer exercises, seller must deliver. In silver futures options, this means delivering futures contracts convertible to physical silver. Most of the time options don't get exercised for delivery, closed out for cash profit, or expire worthless. But when there's significant open interest at a particular strike and underlying commodity is above that strike, there's always theoretical possibility of mass exercise. With 41,000 contracts at $75 strike and silver trading above that level, anyone holding those options could theoretically demand exercise and convert to futures positions that could stand for delivery. The analyst quoting Hindu business line stated precious metal has to be delivered if prices reach that level. technically accurate but needs context. Most option exercises are cash settled or rolled into new futures, never resulting in physical delivery. However, the possibility exists, and in a tight physical market where supply is constrained, even small percentage standing for delivery creates problems. Think of it as theoretical gun held to head of short sellers. As long as nobody pulls trigger and demands delivery, everything stays calm. But uncertainty about whether someone might pull that trigger creates stress. Raising margins and bringing prices down reduces that stress by making option exercise less likely. What you should watch over coming days and weeks if you're interested in or trading silver. Watch the spread between Shanghai and COMEX. If it continues compressing, selling pressure dominates. If it stabilizes or starts widening again, physical demand may be reasserting itself. Watch trading volume. Forced liquidations create high volume. Once forced selling exhausts, volume typically drops as market finds new equilibrium. If volume remains elevated with prices continuing to fall, it suggests real selling pressure beyond forced liquidations. Watch for follow-up COMEX announcements. Sometimes one margin increase is the end. Other times exchanges raise margins multiple times in succession to really cool off a market. Second margin increase is strong signal the exchange is committed to bringing prices down. Watch what other analysts and major players are saying. Are industrial users expressing concern about silver availability? Are major funds increasing or decreasing positions? Are central banks or governments making moves related to silver? These macro factors can override short-term technical disruptions. For those trading other commodities, these lessons apply universally. Copper, gold, crude oil, agricultural commodities, all trade on exchanges with power to change margin requirements. All can experience forced liquidation cascades. All have situations where option expiration or delivery obligations create market stress. Specific details change, but underlying mechanics are identical. Trading with maximum leverage and minimum margins makes you vulnerable. Ignoring option expiration calendars and open interest data means you're flying blind. Not monitoring exchange announcements and policy changes means you're missing critical information. These edges separate traders who survive long-term from those who get wiped out in situations exactly like today. Margin increases tend to happen at the worst possible time for you and best possible time for institutions you're trading against. If you're long silver and it's been climbing, you're feeling confident. Maybe you added to position as it rose, pyramiding winners. Accounts showing nice, unrealized profits. Then boom, margin increase. Suddenly, those unrealized profits aren't enough to cover new requirements. You're forced to close the position, making you money. Meanwhile, traders waiting on sidelines or who were short and losing get a gift. Prices drop sharply from forced selling. They enter long positions at better prices or cover shorts at profit. This wealth transfer from weak hands to strong hands happens repeatedly in commodity markets. Rules are designed, intentionally or not, to favor deep-pocketed institutional traders over retail participants. The only way to compete is trade like an institution, even if you're not one. Proper capitalization, conservative position sizing, extensive margin cushions, never being in a situation where sudden rule change wipes you out. For anyone thinking about trading silver after this shakeout, consider this. If fundamentals that drove silver higher are still intact, this could represent buying opportunity. Industrial demand for silver in solar panels, electronics, other technologies continues growing. Investment demand for precious metals as inflation hedges remain strong. Mining supply is constrained. These factors don't change because COMEX raised margins. What changed is price and sentiment. Prices are lower. Sentiment is more fearful. That's typically when best opportunities emerge, not when everyone is euphoric and piling in. But, and this is critical, you need to enter any new positions with proper risk management. That means accepting you could be wrong. Sizing positions conservatively, maintaining those 150 to 200% margin cushions.